Assalamu alaikum. How are you, beta?
Walaikum salam, ma'am. I'm fine, thank you.
Good. Okay. Okay. So, beta, today is lecture number 12, including the assignments lecture. And in today's lecture, we will be studying the second part of learning outcome number 4. Okay. We will learn that what is the role of monetary and fiscal policy in economic stability of any organization and the possible impact on organizations and their activities. So basically, monetary and fiscal policies, these are two basic policies that every organization follow in order to have more stabilized economy. Or these are some policies not only used by the organizations but the other institutions to have a positive or strong impact on the organizations. The investment decisions made by corporations can have an important impact on the real economy and corporate profits. Okay, so in investment decisions. Okay, why these two policies are very important for any organization? Organization have to follow one of the two policies in terms of the investment. Why? Because the investment decision, they are very important for the strength of economy as well as the profit of that organization. But individual corporations can rarely affect large economies on their own. Of course, when any corporation is working individually, is gaining profit individually, of course, that corporation will not be able to multiply its profit. It has to take benefit from other organization in terms of financial aid. Now that those organizations can be any bank or any other strong organization that can provide financial aid to the corporation. By contrast, the decisions made by the governments can have an enormous impact on even the largest and most developed of economies for two main reasons. Okay, so every time, whenever any organization has to follow either of the policies, it has to comply with the decisions made by governments. And for that, there are basically two main reasons why the organization is following the decisions of the government. First, the public sectors of most developed economies normally employ a significant proportion of the population, and they are usually responsible for a significant proportion of spending in an economy. Okay, so public sector or the government sector organizations, it is very important for any private sector organization to collaborate with the public sector or government sector organizations. Or you can say private sector organization has to follow the decisions made by the government or the public sectors. Why? Because most of the developed economies, most of the developed countries, they employ a significant number of population. Okay, and that population is basically responsible for spending in any economy by paying taxes. Okay. Second main reason is the governments are also the largest borrowers in the world debt markets. So if you people remember the lecture in which we studied about the sectors, I told you people that government is one of the major or one of the main consumer or customer of the private sector organizations. Okay, so for that, two main reasons, almost every private sector organization need to collaborate with the government sector or the public sector organizations. By collaborating with them, of course, their profit will easily multiply. And secondly, the public sector contains a large population or contain a number of people who is responsible for spending money or investing money. So for these two main reasons, the collaboration should be done. Government policy is ultimately Government policy is ultimately expressed through its borrowing and spending activities. In this reading, we identify and discuss the two types of government policies. And what are these policies? Monetary and fiscal policies that can affect the macroeconomy and the financial markets. So, monetary and fiscal policy will be discussed in today's lecture. Monetary policy and fiscal policy refer to the two most widely recognized tools used to influence our nation's economic activity. Okay, so it means that these two policies, either it is monetary policy, or the fiscal policy, these two tools are widely used by a number of economies, whether they are the organization belong to some underdeveloped country, any developed country, or developing country. Every organization present in that country has to follow either of the policies. First is monetary policy. Monetary policy is primarily concerned with the management of interest rates and the total supply of money in circulation, and is generally carried out by the central banks, such as the US Federal Reserve. It is the bank present in USA. Okay, so what is monetary policy? Monetary policy is related to the management of interest rates and the supply of money, the total supply of money. Basically, the money circulating among the organization and the central bank. Okay, so monetary policy is the policy that is concerned with the management of interest rate and the total supply of money. And it is usually done by the central banks of any country. So monetary policy refers to the central bank activities that are directed towards influencing the quantity of the money and credit in an economy. So basically, this policy is aimed upon the activity of the central banks, and the activity of central bank is influencing the supply of money. Okay, the supply of money and the credits present in the economy of the country due to that organization. And now, what is fiscal policy? Fiscal policy refers to the government's decision about taxation and spending. Fiscal policy is a collective term for taxing and spending actions of the governments. In the United States, the national fiscal policy is determined by the executive and legislative branches of the government. So, monetary policy was basically carried out by the central banks, while the fiscal policy is carried out by the different branches of the government. They can be executive and the legislative branches. Legislative branches are those branches that are directly involved in the law enforcement in any country. So the monetary policy was concerned with the management of interest and the supply of money, while the fiscal policy is related to the taxation and the spending actions of any government. Okay, so these are the two policies, and either of them, or most of the times, both of them will be followed by any organization. The overarching goal of both monetary and fiscal policy is normally the creation of an economic environment where the growth is stable and positive and inflation is stable and low. So the main aim of both policies, either it is monetary or the fiscal policy, the main aim is the creation of economic environment, means the main aim is the stability of the economy. Okay, where the growth is stable and positive and inflation is stable and low. So this is the ideal situation. When is your economy stable? Your economy will be stable when growth of your organization, the growth of the profit is stable and positive, and the inflation is stable and low. Mean the profit is growing very well and the inflation is becoming low or either stable. Then it means that economic stability of the country has been achieved. Crucial and organizations play a very important part in stabilizing the economy of any country. Crucially, the aim is therefore to steer the underlying economy so that it does not experience the economic booms that may be followed by the extended periods of low or negative growth and high levels of unemployment. Okay, so the first aim was, of course, to stabilize the economy of the country. The second aim of both of the policies is to reduce unemployment from the country. In such a stable economic environment, householders can feel secure in their consumption and saving decisions, while the corporations can concentrate on their investment decisions and on making profits for their shareholders. So, when the economy has been stabilized, when the growth is increasing positively, and the inflation has become either stable or lowering with each passing day, in such conditions, the householders, the person who are not owning any business but they are basically the job holders or simply running their houses by daily wages, they can feel secure in saving their money. They will feel secure in consuming their money in a positive way. And while the corporations or the business, they will then focus on their better investment decisions, and they will also focus on multiplying their profit. The challenge to achieving this overarching goal are many. Not only the economy is frequently buffeted by the shocks, such as oil price jumps, but some economists believe that natural cycles in the economy also exists. Okay, so this thing is not very smooth as it seems so. Achieving economic stability has been a big challenge for all the corporations from uh, since so long, because sometimes many hurdles can appear. For example, oil prices can jump. Okay, so inflation will increase abruptly, and in such situations, it become very difficult for the corporations to multiply their profit and to make the economy of the country stable. So some economists believe that there are basically the natural cycles in the economy. There may be high, there may be lows during the whole procedure or the process. Moreover, there are plenty of examples from the history where the government policies, either monetary or fiscal or both, have exacerbated an economic expansion that eventually led to damaging consequences for the real economy, for financial markets, and for the investors as well. So it has been seen in the past that either the organizations were following the monetary policy or the fiscal policy, they eventually they suffered an economic expansion to such a big level that damaging consequences occur, damaging results occur, and as a result of which the real economy of the country also was damaged to a bad extent, really bad extent. The practices of both monetary and fiscal policies. Let's have a look on practices of both these policies. Both can have a significant impact on economic activity, and it is for this reason that financial analysts need to be aware of the tools of both monetary and fiscal policy. The goals of the monetary and the policy, fiscal authorities, and most important, the monetary and fiscal policy transmission mechanisms are as follows. It is very important to understand what will be the impact of either of these policies on the economy. The two sets of policies affect the economy via different mechanisms. Okay, so how they will affect the economy? Either they will increase the employment, they will increase the job opportunities, or the second method will be that they will directly affect the economy of the country, play an important role in devising such decisions that inflation can be reduced with the passage of time. Money fulfills three important functions. Of course, when um, these policies are helping the organization and multiplying the profit, then how that profit will be very important, how the money will be fulfilling the major needs of the country, or how the money will be actually affecting the real economy of the country. It acts as a medium of exchange, provides the individuals with a way of storing wealth, and provides society with a convenient unit of account. Via the process of fractional reserve banking, the banking system can create money. So, money will be playing an important role in providing the individuals the way of storing their wealth. How will they store their wealth? In the form of money, in the form of cash. Okay, the money will also enable the people. enable enough to open up their bank accounts. And by opening their bank accounts, they are not only making their savings safe, but also they are basically opening up job opportunities for the other individuals. They're actually playing their part in building up the progress of any bank. And the third main function will be fractional reserve banking system can create money. Okay, so the banks will be able to generate their revenue from their customers money. Okay, so there will be three main functions or three main benefits of the money. First is enable the individuals to save their money in the form of cash, to enable the individuals to open up their bank accounts in any bank, and the bank systems will be able to generate more revenue from that money. The amount of wealth that the citizens of an economy choose to hold in the form of money, as opposed to, for example, bonds or equities, is known as demand for money. There are three basic motives for holding money: transaction related, precautionary, and speculative. Okay, so again, the same thing has been explained that in order to buy some bonds or equities, the individuals will be saving their money in cash form in the banks. The nominal rate of interest is comprised of three components: a real required rate of return, a component to compensate the lenders for future inflation, and a risk premium to compensate the lenders for uncertainty. For example, about the future rate of inflation. Okay, so the rate of interest that will be applied on the money will comprise of three main components: the real rate that will be required for on return. Second will be component to compensate the lenders. Who are the lenders? Usually the banks are the lenders. That will give loan to the organizations, or that will give loan to the individuals for future inflation. Okay, so the interest rate will comprise of three parts. The first part consists of the actual rate of return. The second part with the return rate that will be needed to compensate the lenders. And the second will be a risk premium to compensate the lenders. For example, about the future rate of inflation. So this is just an uncertainty that in case if the inflation increases to a certain value in future, then the interest rate, a portion of the interest rate will help the bank to cope up with that situation. Central banks takes on multiple roles in modern economies. They are usually the monopoly supplier of their currency, the lender of the last resort to the banking sector, the government's bank, and the bank of the banks. And they often supervise banks. Okay, so central banks are the main bank of any country. They will be basically acting or providing the multiple roles in economy. They will be monopoly supplier of the currency. Okay, they are the sole leaders for providing the currencies to all the banks. The lender of the last resort to the banking sector, of course, because they are the monopolies and bank, they are the central bank. So they will be actual lender of for all the banks, all the organizations. The government's bank and the bank of the banks. Okay, so the central bank is always the government's bank, the main bank, and it is also known as the bank of the banks. Every bank, whether they are from the private sector or they are from the public sector bank, they have to consult with the central bank of any country for the purpose of taking any loan, for the purpose of reporting, and for the purpose of management of their proper working. Okay, so the main bank for all the banks of the country is the central bank, and they often supervise the banks. Yes, of course, every decision, every rule that is circulated or that is basically implemented on the banks, that will be devised by the central bank. Central bank will assure that how the other banks will work accordingly. Although they may express their objectives in different ways, the overarching objective of most central banks is the price stability. This is the ultimate agenda of every organization from business point of view. Either they are banks, they are any business organization, they are any import export organization. Everyone will be focusing on the economic stability of the country, and everyone will be multiplying their growth, their profit. For a central bank to be able to implement monetary policy objectively, it should have a degree of independence from the government, be credible, and be transparent in its goals and objectives. Okay, so in case of monetary policy implementation, who is responsible for implementing the monetary policy? Central bank of any country. So when central bank will be responsible to implement the monetary policy, it should be independent enough to implement this policy in any organization, and the central bank should not depend upon the government in order for the implementation of this policy, while the fiscal policy is implemented by the legislative department of the government. Okay, the monetary policy is implemented by the banks, central bank. The ultimate challenge for central banks as they try to manipulate the supply of the money to influence the economy is that they cannot control the amount of the money that households and corporations put in banks on deposit, nor they can easily control the willingness of banks to create money by expanding credit. Taken together, this also means that they cannot always control the money supply. Therefore, there are definite limits to the power of monetary policy. So, what we have studied in the definition is that monetary policy will be controlling the supply of the money. But here it is explained that central banks usually have a certain limit up to which they can control the supply of the money. Okay, the concept of money neutrality is usually interpreted as the meaning that money cannot be influenced. Why the central banks cannot control the supply of money completely? Because the money deposition is not in their hands, and they can also not control the willingness of banks to create more profit from the money that has been deposited by the individuals or the householders in the bank. The concept of money neutrality is usually interpreted as meaning that money cannot influence the real economy in the long run. However, by setting of its policy rate, a central bank hopes to influence the real economy via the policy rate's impact on other market interest rates, assets prices, the exchange rate, and the expectations of the economic agents. Okay, so basically, only money, just the deposition of money in banks or the central bank, it will not affect the economy of any country in the long run. There are many other things that are basically involved in creating the strong economy or maintaining the real economy of any country. And such things are interest rates, the exchange rates, and the expectation of economic agents. Economic agents are organizations, how they are working, how they are basically multiplying their revenue. This is the main how they are becoming more successful. Their success rate also determines the stabilization of economy of any country. Inflation targeting is the most common monetary policy, although exchange rate targeting is also used as particularly in developing economies. Fiscal policy involves the use of government spending and revenue raising taxation to impact a number of aspects of the economy. Achha, okay, now we are talking about the fiscal policy. Policy has been implemented by the legislative department of the government. So involves the use of government spending and revenue raising, that is taxation, and impact on a number of aspects of the economy, the overall level of aggregate demand in any economy, and hence the level of economic activity, the distribution of income and wealth among different segments of the population, and hence ultimately the allocation of the resources between the different sectors and economic agents. So monetary policy was also just concerned between the organization and the central bank and the supply of money between the two. While the fiscal policy is implemented by the government department and it is concerned with the taxation and the spending of money, Okay, and it is impacting the economy in a number of different ways. For example, the overall rate of demand in any economy, how much the products or the commodities are in demand as a result of proper functioning of organization. This is also basically multiplying the economy. When any organization is producing quality products, and these quality products are higher in demand by the population, and they are ordering or demanding the product again and again, the markets are demanding that product again, it means that the organization is playing its part in developing the economy of the country. Then comes the distribution of income and wealth among different segments of the population. There should be smooth distribution of wealth among different segments of population, and it is also done by the government. Okay, and it will be done by the implementation of the fiscal policy, and hence ultimately the allocation of resources between different sectors and the economic agents. The tools that governments use in implementing this fiscal policy are related to the way in which they raise the revenue and the different forms of expenditure. Governments usually raise money via combination of direct and indirect taxes, because in fiscal policy taxation and revenue generation is involved. Government expenditure can be current on goods and services or can take the form of capital expenditure, for example, on infrastructure projects. Okay, so the fiscal policy is basically playing its part in generating the revenue in the form of taxes. Okay, in the form of subsidies and taxes. The government will be the sole proprietorship in providing or in determining the taxes on different products. Okay, now the taxes can be direct or the indirect services. They can be as small as the taxes on any good or service, and they can be a capital expenditure taxes, for example, on the infrastructure projects of any organization. As economic growth weakens or when it is in recession, a government can enact an expansionary fiscal policy, for example, by raising the expenditure without an offsetting increase in taxation. If the economy is becoming weak, of if the economy of any country is becoming weak, then government will introduce an expansionary fiscal policy. For example, the government will raise the expenses without increasing the taxation on the products. Okay, the government will basically fight with raising the expenditure on providing the goods and services to the individuals, but the taxes will remain the same. The taxes will not be increased because the economy is already becoming weak. The individual, it will become very difficult for the individuals to cope up with the inflation in this case. Conversely, by reducing the expenditure and maintaining the tax revenues, a contractionary policy might reduce the economic activity. Fiscal policy can therefore play an important role in stabilizing an economy. It means that fiscal policy is more efficient policy as compared to the monetary policy, because fiscal policy is directly related with the taxation and revenue generation, and in case if the economy of any country is becoming weak, in such cases, the government can cope up with inflation by increasing the expenditure, but by keeping the taxes the same as they were before. Although both fiscal and monetary policy can alter the aggregate demand, the work through different channels, the policies are therefore not interchangeable, and they conceivably can work against one another unless the government and the central bank coordinate their objectives. Okay, so it means that both of the policies basically play an important role in in stabilizing the economy of any country. But in this case, the government and the central bank, they have to work in collaboration. Okay, let us see what is monetary policy and fiscal policy separately, how they are working separately. Monet- uh, Now we have just ended up with the impact of monetary policy and the fiscal policy together, and now we are having a look on these policies separately. Monetary policy. Central banks typically have used monetary policy to either stimulate an economy or to check its growth by incentivizing the individuals and businesses to borrow and spend. The monetary policy aims to spur the economic activity. Okay, so central banks are basically using the monetary policy either to stimulate the economy of any country or to check its growth. Conversely, by restricting the spending and incentivizing the savings, monetary policy can act as a brake on inflation and other issues associated with an overheated economy. Okay, so one of the major action that will be taken up by the central banks in case in need of in the time of inflation, the central banks will restrict this spending more money and providing more incentives to the individuals by implementing the monetary policy. So at this point, where the incentives will be restricted, where more money spending of money is restricted, in this case, the monetary policy will directly act on breaking the inflation rate. The Federal Reserve, also known as the Fed, frequently has used three different policy tools to influence the economy. Number one is the open market operations, changing the reserve requirements for banks and setting the discount rate. Open market operations are carried out on daily basis when the Fed, that is, Federal Reserve, buys and sells the US government bonds to either inject money into the economy or pull money out of circulation. Okay, so the first method that will be adopted by the monetary policy in the need of inflation is open market operation. In open market operation, um, basically these operations are carried out on daily basis, where the Federal Reserve usually buys and sells the government bonds. Okay, the bonds or the equities will be bought from the government or sold to the government in either in by either injecting the money into the economy, means by multiplying into the economy, or by pulling the money out of circulation. For example, if the money is circulated among the organization, the central banks and the government, so the money will be pulled out of this circle and will be just will be reserved for the stabilizing the economy. So this is known as open market operation. Either the money will be injected into the circle or the money will be taken out of the circle for the stabilization of economy. By setting the reserve ratio or the percentage of the deposits that banks are required to keep in reserve. The first is the open market operations that will be carried out on daily basis, and the main aim of such open market operation is to increase the stability of the country. How? By either injecting the money into the circle between the organization, the government, the central banks, or by taking out the money from that circle. By setting the reserve ratio. Reserve ratio mean by setting the so by setting the reserve ratio. Reserve ratio means that by setting a proper ratio or by setting a proper limit. And at this limit, beyond this limit, the reserves will not be deposited in the bank. Reserve means the money, the cash that is basically deposited by the individuals. Okay, so a reserve or a limit will be finalized, and beyond that limit, no more cash or no more revenue will be deposited in the bank. The Fed can also target, Fed means Federal Reserve, can also target the changes in the discount rate. The interest rate it charges on loans it makes to financial institutions, which is intended to impact the short term interest rates across the entire economy. Okay, so the Federal Revenue Reserve can also target the changes in the discount rate. And what is the discount rate? Discount rate is basically the interest rate that is basically omitted from the products for a shorter period of time. Okay, so such discount rates can also be targeted in the time of inflation. Monetary policy is more of a blunt tool in terms of expanding and contracting the money supply to influence the inflation and growth, and it has less impact on the real economy. For example, the Fed was aggressive during the Great Depression. Its actions prevented the deflation and economic collapse but did not generate significant economic growth to reverse the lost output and the jobs. Okay, so basically, the monetary policy, like the fiscal policy, it is also related with generating. Okay, so like the fiscal policy, monetary policy is also, of course, also related with the revenue generation and economy stabilization. But whenever the inflation goes up to a very higher level, that state is known as the depression state. In that state, monetary policy usually fails to cope up with the inflation because monetary policy is only related with the supply of money. And in such cases, in such time of inflation, the fiscal policy basically excels. It can deal very well with the time of inflation. How? Because it is directly related with the taxation and the subsidizing. Expansionary monetary policy can have limited effects on growth by increasing the asset prices and lowering the costs of borrowing and making companies more profitable. Okay, so monetary policy has limited effect on growth by increasing the asset prices and lowering the cost of borrowing. Yes, of course, it will have a limited effect because it is not related with the, it is not targeted on the taxes and it is not targeted on the subsidies. It is just concerned with the supply of the money. Monetary policy seeks to spark the economic activity, while the fiscal policy seeks to address either the total spending, the total composition of spending, or both. Exactly, because something that is related with the taxes, tax generation, it is directly related with the revenue generation. While another policy that is just related with the supply of the money, it cannot basically increase the economy to much level. Next is the fiscal policy. The aim of most government fiscal policies is to target the total level of spending, the total composition of spending, or both in an economy. Okay, so as we have learned earlier, or we have discussed it earlier, that the basic aim is, of course, the revenue generation, the economy stabilization. Now, how the fiscal policy is working? It is working on the either the total level of spending of money or the total composition of spending. Means it is related with either the uh, revenue generation, that is composition of spending, and it is either or the spending of money by the individuals or by the organizations for the betterment of community. The two most widely used means of affecting fiscal policy are changes in the government spending policies or in the government tax policies. If a government believes that there is not enough business activity in any economy, it can increase the amount of money it spends, often referred to as the stimulus spending. If there are not enough tax receipts to pay for the spending increases, the government borrow money by issuing the debt securities such as the government bonds and in the process accumulate the debt. This is referred to as deficit spending. Okay, now what is stimulus spending and what is deficit spending? Stimulus spending is that if the government believes or government observe, because in fiscal policy government is directly involved instead of central bank, government is directly involved. And if the government observe that there is no enough business activity is not happening in economy, then government increases the amount, or you can say the government increases uh, start spending more amount in the business. This will be known as the stimulus spending. The government is basically aiding the businesses or the organizations to work more efficiently. This is known as stimulus spending. And if the government observes that there are not enough tax receipts to pay for the spending, then it will increase the tax receipts for spending. This is known as deficit spending. And how the tax receipts will be increased? By a generation of introducing the bonds, by introducing the equities. So, in this way, more tax receipts will be available for any organization. Okay. Then, in comparing the two, the fiscal policy generally has a greater impact on consumers than the monetary policy, and it can lead to increase the employment and income. And I have told you people earlier why fiscal policy a greater impact than the monetary policy, because fiscal policy is related with the tax generation and revenue generation, tax implementation and revenue generation. By increasing the taxes, the governments pull money out of the economy and slow business activity. Typically, the fiscal policy is used when the government seeks to stimulate the economy. It might lower the taxes or offer the taxes rebates in an effort to encourage the economic growth. Influencing economic outcomes via fiscal policy is one of the core tenets of the Keynesian economies. That is basically the economy of Kenya. Okay, so how the tax implementation will directly playing its part in revenue generation, because in this way the governments are basically pulling out the money from the profit of any business. So this money will be directly affecting the economy of the country. The economy of the country is becoming more stronger. Much revenue will be present in the account of any government, and it will directly decrease the inflation. When a government spends money or changes the tax policy, it must choose whether to spend or what to tax. In doing so, the government fiscal policy can target specific communities, industries, investments, or the commodities to either favor or discourage the production. Okay, so whenever the government is applying the taxes, of course, the government will not blindly apply the tax. It will observe that which areas uh, need tax application and to which extent the taxes can be applied on the products. Sometimes its sections are based on considerations that are not entirely economic. For this reason, fiscal policy often is hotly debated among the economists and the political observers. Why the fiscal policy will be hotly debated? Because when the government is about to apply taxes on the products, the government is basically aiming on taking out the money from their profit. So every time the government will do so, the main aim will be, of course, the economic stabilization. And in such some cases, when any organization is not basically multiplying very successfully, and the tax has been applied by the government on their products, maybe the government, the organization itself will face loss in profit, because the taxes have been applied, the prices of the products will be increased as a result, and maybe the consumers or the customers will not buy their product as efficiently as before. But because the government has to take its percentage from their profit and the government will take that percentage, now the economy of the country is multiplying, but the profit of the organization is not coming out as much as it was expected. That is why fiscal policy is sometimes taken negatively by some economists. Fiscal policy is crucial part of the American economies. Both the executive and the legislative branches of the government determine fiscal policy and use it to influence the economy by adjusting the revenue and spending levels. Yes, we have studied it earlier. Though those decisions can have significant impacts on your small business. Now, how the fiscal policy is impacting your business? If we talk about just fiscal policy, public and private companies experience direct effects of an economy's fiscal policy, whether in the form of spending or taxation. Fiscal policy can have the following effects on your small business. Investment opportunities, number one. The businesses will see more investment opportunities related to the government spending. This commonly occurs during an expansionary fiscal policy when more money is flowing into the economy from the government and from other sources since the taxation is also low. When a balance between the price and demand is met, then companies can expect to thrive and grow. Okay, so what kind of investment opportunities will be offered by the government? In such cases, when more money is flowing from the government to the organizations, the taxes are applied to a lower level or a minimal taxes have been applied on the products. In this case, the organizations are growing very well while the government is not generating or not taking out much revenue from the organizations. Okay, so in this way, the fiscal policy is providing the organizations with more investment opportunities because the organizations are able to fetch more money from the organizations, government, sorry. A contractionary fiscal policy may kick in to prevent inflation when the balance is broken and demand and prices fall. Okay, due to fiscal policy, there may be slower growth of the success rate of any organization. Why? Because organizations will play their part to directly multiply the economy of any country. Basically, the organization is fighting with the inflation in any country. The balance is broken here, and the demand of the product and eventually the prices of the product need to be higher, but they will fall. Businesses typically rein in their growth due to rising taxes and take measures to stay in the black with less money flowing through the economy. Next is taxation changes. Depending on your company's location, your business will face several levels of taxation, including the local, state, and federal. These are three kinds of taxation that any organization will face due to its location. Consider how your state and local government taxes your company and how it interweaves with federal fiscal policy. Okay, so now it is basically judged by the organization itself that how the local taxes, the state taxes, and the federal taxation will be applied on the business. Fiscal policy also impacts on the amount of taxation on future generations. The government spending that leads to greater deficits means that taxation will eventually have to increase to pay interest because the government is basically spending the money in the form of deficit spending. So it means that taxation will have to be increased in order to pay the interest. Last is unemployment rates. A major objective of fiscal policy is to minimize the unemployment. For example, the government can lower the taxes to put more money back into the consumer's pocket. Okay, the government will always increase the tax if it needs to draw more money from the organization. But whenever the government is lowering the taxes, the government is not only aiding the individuals or the consumers, but also the organizations as well. As such, consumers have more money to spend and companies may face increased demand because the taxes has been lowered. The consumers or the individuals or the citizens, they have more money to spend on the products. As a result of which, there will be an increased demand of the products because now the individuals are having money, they will buy things more and more. With increased demand, may come additional production tasks for companies to complete. Okay, and in businesses can respond by creating more jobs and hiring more employees. With proper fiscal policy in place, a low unemployment rate may be gradually increased. Okay, now because there is more demand of the products, the workload on the organizations will increase. As a result of this workload, there will be more job opportunities in the organization. So fiscal policy is basically directly affecting the job rates or the employment rates. Impact of monetary policy. The transmission of monetary policy, we have discussed them together before, the impact of monetary policy and impact of fiscal policy, and now we have discussed it separately. We have discussed the impact of fiscal policy, and now comes the monetary policy. The transmission of monetary policy describes how the changes made by the Reserve Bank to its monetary policy settings flow through to economic activity and inflation. Reserve Bank is the central bank. This process is complex and there is large degree of uncertainty about timing and size of the impact on the economy. In simple terms, the transmission can be summarized into two stages. So basically, there are two stages the way the monetary policy is affecting the economy of any country. The stages are the changes to monetary policy affect the interest rates in the economy and the changes to interest rates that are affecting the economic activity and inflation. So all these, both of these stages are basically the vice versa of each other, opposite of each other. So if we talk about the first stage, the monetary policy is determined by the Reserve Bank Board, that is central bank board. The primary and conventional tool for monetary policy is target for the cash rate. As you remember, we have just discussed that monetary policy will basically make the individuals able to save their money in terms of cash in the bank. But other tools have included forward guidance, price, and quantity targets for the purchase of government bonds and the provision of low cost fixed term funding to the financial institutions. So, not only the cash, the monetary policy is also motivating the individuals to buy the bond and equities. The first stage of transmission is about how the changes to setting for these tools influence the interest rates in the economy. The cash rate is the market interest rate for the overnight loans between the financial institutions, and it has a strong influence over other interest rates such as deposits and lending rates for households and business. Okay, so this stage is basically affecting the transmission, or you can say the changes uh, that will occur as a result of the interest rates in the economy. Okay, so this stage is basically aimed on influencing the interest rate in the economy. The cash rate is market interest rate for overnight loans because as we have discussed earlier that when individual corporations are working in any market, they need to collaborate with other institutions, other organizations, and the government as well. So in such cases, there will be a supply of money between the other organizations and the individual corporation or the bank and the individual corporation. The Reserve Bank's other monetary policy tools work primarily by affecting the long term interest rates in the economy. While the monetary policy acts as the benchmark for the interest rates in the economy, it is not only the determinant. Other factors such as conditions in the financial markets, changes in the competition, and the risk associated with the different types of loans can also impact the interest rates. As a result, the spread or the difference between the cash rate and the interest rates varies over time. Okay, so because the monetary policy is the individual benchmark in the interest rates of the economy, so there will be a number of other factors which will be directly affecting the economy of the country, such as the conditions of the market, the changes in the competition, and the flow of the money between the organization and the different types of loans. Okay, they will also affect the growth rate of economy. Second stage. The second stage of transmission is about how changes to monetary policy influence the economic activity and inflation. Okay, so second stage is about the changes in the monetary policy, the after effects of changes in the monetary policy, how they are affecting the economic activity and the inflation as well. To highlight this, we can use a simple example of how lower interest rates for households and businesses affect the aggregate demand and inflation. Higher interest rates have the opposite effect on demand and inflation. Of course, opposite effects means when interest rates have been increased, there will be lesser demand and the inflation will increase, of course. Aggregate demand. Lower interest rates increases the aggregate demand by stimulating spending, but it can take a while for the supply of goods and services to respond because more workers, equipments, and infrastructure may be required to produce them. Because of this, aggregate demand is initially greater than aggregate supply, putting upward pressure on the prices as the business increase their prices more rapidly in response to higher demand. This leads to higher inflation. So this is the cycle. As a result of lower interest rates, of course, the consumers more money will be going into the consumer's pocket, and there will be higher demand of the products. Why there will be higher demand of the product? Because the individuals will be having more money. As a result of higher demand, there will be increase in workload on the institutions, organizations, and as a result of increased workload, they will hire more individuals, more workers, and because of this higher demand, higher workload, increased hiring of the workers, of course, the businesses will increase the price of their products more rapidly. And due to the increase in prices as a result of the higher demand, this leads to inflation. So, this is the complete cycle of inflation. Inflation will increase as a result of aggregate demand. There is a lag between changes to monetary policy and its effect on economic activity and inflation because households and businesses take time to adjust their behavior. Some estimates suggest that it takes between 1 and 2 years for monetary policy to have its maximum effect. Because monetary policy is circulating the money among the organizations, the banks, and the government, if required. So it will take some years to stabilize the economy. However, there is a larger degree of uncertainty about these estimates because the structure of the economy changes over time and economic conditions vary. Because of this, the overall effects of monetary policy and the length of time it takes to affect the economy can vary. So, the whole time or duration is basically dependent upon the stabilization. As soon as the stabilization will achieve, the monetary policy will be successful in achieving its goal. Inflation expectations. Inflation expectations also matter for the transmission of monetary policy. For example, if the workers expect inflation to increase, they might ask for the lower wage increases to keep up with the changes in inflation. Higher wage growth would then contribute to higher inflation. Okay, so inflation expectation is directly concerned with the supply of the money. If the workers demand more wages, they demand more pays for themselves. So basically, they are demanding an increase in the inflation. By having an inflation target, the central bank can anchor inflation expectations. This should increase the confidence of the households and the businesses in making decisions about saving and investment because uncertainty about the economy is reduced. Channels of monetary policy transmission, how monetary policy is basically transmitted from the central banks to the organizations and then so on. Saving and investment channels. So, this is one of the most important and the channel that is most commonly used by the central bank. Monetary policy influences economic activity by changing the incentives for savings and investment. This channel typically affects the consumption, housing investment, and the business investment. So, all these things are basically happening in the central bank. Okay, whether it is consumption of the money, it is housing investment, it is business investment, all these three things are happening in the bank. Every kind of investment will occur in the bank. Lower interest rates on the bank deposit reduces the incentives households have to save their money. Instead, there is an increased incentive for household to spend their money on goods and services. Lower interest rates for loan can encourage the households to borrow more as they face lower repayments. Because of this, lower renting rates support high demands for assets such as housing. Okay, if lower interest rates are offered on deposits, bank deposits, then households or the persons, the job holding persons, they will save their money in the banks because, of course, the lower interest rates have been applied. Okay, so and if the interest rates have been increased, then the households or the job holders they will spend their money on goods and services because the banks are offering the greater interest rates. They will not save their money in the form of cash in banks. So, and in the same way, if the lower interest rates for loans have been offered, then the households or the job holders will borrow more money from the banks because lower repayments have been offered. As a result of which, as a result of lower lending rates, there will be demand of assets such as housings. So the job pairs will then look for the assets or the like the housing or the property because lower rates on loans have been offered. They will take the loan from the banks and they will buy them houses or properties. Lower lending rates can increase the investment spending by businesses on capital goods like new equipment or buildings. This is because the cost of borrowing is lower and because of the increased demand for the goods and services they supply. This means that returns on these projects are now more likely to be higher than the cost of borrowing, helping to justify going ahead with the projects. This will have a more direct effect on businesses than borrow to fund their projects, will debt rather than those that use the business owners' funds. Okay, so the previous 2 points were for job holders, but in the same case, if the lower lending rates are offered by the banks for the investments on businesses, then the organizations will look forward to buy more developed or high tech equipments, or they will look for buying new buildings because they are facing increased demand of the product as well as they are facing the increased workload due to high demand of the products. So they will positively look forward for buying new equipments and the buildings because lower interest rates have been offered by the banks. Cash flow channel. Okay, so the first way was the saving and investment channel that is playing a great role in lowering the inflation, and the second is cash flow channel. Monetary policy influences interest rates, which affect the decisions of the households and the businesses by changing the amount of cash they have available to spend on goods and services. This is an important channel for those that are liquidity constrained. For example, those who have already borrowed up to the maximum that banks will provide. Okay, so monetary policy also influence the interest rates. It means due to these changing interest rates, the decisions of the households and the businessman will also change. A reduction in the lending rates reduces the interest repayments on debt, increasing the amount of cash available for the household and businesses to spend on goods and services. For example, a reduction in interest rates lowers the repayments for households with variable rate mortgages, leaving them with more disposable income. Because the banks are offering the lower interest rates, both the job holders as well as the businessmen, they will be left behind with a handsome amount of money in the banks. So they will be looking forward to grow their business, or in case of household, they will be looking forward to save their money. At the same time, a reduction in the interest rates reduces the amount of income that households and the businesses get from the deposits, and some may choose to restrict their spending. So, the interest rate in terms of loan will be a positive point for both of these individuals, households and the businessmen. But if they are taking the profit on their deposited money, and if the profit has been reduced, then of course they will look behind some other ways of saving their money. These two effects work in opposite directions, but a reduction in interest rates can be expected to increase spending in the Australian economy through this channel, with the first effect larger than the second. Okay, so the both of these points are basically opposite to each other, but in some economies, like the Australian economy, that is not so much developed economy, the first point has larger effect. First point, what is the first point? The first point where the households and the businessmen, they are offering the lower interest rates, means they are getting more profit from their saved money. Assets price and the wealth channel. Asset price and the people's wealth influence how much money they can borrow and how much they spend in the economy. The asset prices and the wealth channel typically affects consumption and investment. Consumption means how they will invest in the business. Sorry, consumption is how much they can borrow from the other institutions, and investment means how much they can spend in the economy. Lower interest rates supports asset prices such as housing and equities by encouraging the demands for assets. One reason for this is because the present discounted value of future income is higher when interest rates are lower. Okay, so when you are looking forward for the future uh, of your organization or your family, then of course lower interests at present are basically a big option for you to invest on housings and making more property. Higher assets prices also increase the equity collateral of an asset that is available for banks to lend against. This can make it easier for households and businesses to borrow. Higher assets prices, they also increase the equity. An increase in asset prices increases the people wealth. Okay, because firstly the interest rates were lower, they tend to buy the houses and the property, and when the interest rate or the assets price will be increased, of course it will directly affect the pocket of the individual or pocket of the proprietor. This can lead to higher consumption and housing investment as the households generally spend some share of any increase in their wealth. Exchange rate channel. The exchange rate can have an important influence on the economic activity and inflation in a small open economy such as Australia. It is typically more important for the sectors that are export oriented or exposed to competition from the imported goods and services. So, if the Reserve Bank lowers the cash rate, it means that the interest rates in the country have fallen compared with the interest rates in the rest of the world. Lower interest rates reduce the return investors earn from the assets in Australia relative to other countries. Lower returns reduce the demands for assets in Australia as well as for the Australian dollars, with the investors shifting their funds to foreign assets and currencies instead. So, whenever the currency of the country is reduced or lowered as compared to the international currency, in such cases, people tend to buy the foreign currency more as compared to the national currency, because they are looking forward to strengthen their economy or their pocket instead of the country economy. And this is known as exchange rate channel, but of course this channel is not multiplying the economy of the country, but it is basically aimed on multiplying the uh, profit of the organization, or if they are job holders, then of course multiplying the money in their accounts or money in their pockets. So this is all about today's lecture, and as a result of today's lecture, I hope so you will be able to compare the monetary and the fiscal policy. Okay, Fisher effect, we have not studied the Fisher effect, so I'll remove this point. You will be able to describe the roles and objectives of central banks. You will be able to contrast the costs of expected and unexpected inflation and describe the tools that are used to implement the monetary policy. Okay, so please do tell me if you have any question to tell me, all of you.
It's clear, ma'am.
Okay,
Clear, ma'am.
all right. Okay, beta, if it is clear to you people, please, if you can define the national entrepreneur strategy. Okay, beta, I have opened the slide. I hope so now. If anyone of you can please tell me what is monetary policy?
Ma'am, it is laid down by the central bank.
Yes, exactly.